There are challenges in the emerging markets. We're not going to shy away just because it's difficult. It is challenging, but there are ways that we can manage it. If you look at India itself or China or Southeast Asia or Africa, right? It's a number population game. I think EM will account 70% of global population and 50% of global GDP by 2050.
Investors are concerned about the risk profile in emerging markets, and rightly so. Country by country, there can be tremendous volatility within countries. Having a disciplined process that tells us this risk has been overestimated, but that's been priced in, and this is a good selling opportunity. Having the discipline that comes with a quantitative approach in markets that can be very volatile is an advantage.
We believe financial services, specifically inclusive financial services, is the single most powerful lever to create economic opportunity for underserved consumers and small businesses. It becomes the oil that greases these economic engines. Our belief is by radically improving access and quality to financial services, we can become the springboard for local economies.
We wanted our capital to be intentional, to really solve the world's key challenges. And it was clear there were large gaps in emerging markets. So we decided then to focus on the underserved in emerging markets, so in Asia, Africa, and LATAM, really impact for communities. I really believe our capital is a key enabler to transform lives and to really amplify the impact. So we want to be able to deploy capital at scale with market returns through experienced impact GPs and highly impactful companies.
Over 83% of you that listen to or watch this show regularly haven't yet subscribed to this show. So could I ask you for a favor before we start today? If you like the show and if you like what we do here and you want to support us, the free and simple way that you can do just that is by hitting the subscribe button or following us on your podcast app. It helps this channel more than you know. Thank you and enjoy this episode. What's Temasek's impact investing theory of change, and what is the problem or the problems that you're trying to solve?
Yeah, so from a theory of change perspective, in the beginning, we spent quite a lot of time defining the problem statement. What are the challenges that we wanted to tackle, but also the sizing of the opportunities. So I mentioned this was during COVID-19, and we saw actually a lot of capital leaving emerging markets. Where there are still very large gaps, even till today. So, World Bank has highlighted that the poverty and inequality decline has really slowed to a standstill. And on climate change, I personally feel we are not on track to tackle that. I think this will disproportionately affect emerging markets. So, for us, we've kind of identified 4 impact pathways. So access, affordability, quality, and knowledge to help, improve the access and the livelihood of the underserved. And I think what's interesting from what we've seen, that a lot of the global challenges are interlinked, whether from the social, economic, health, and climate. And that's why for us, it makes sense to look at the underserved in emerging markets as their needs actually cut across the various sectors. In fact, what we found, the underserved were actually very economically vibrant and very, very resilient. So secondly, we then identified and mapped out what were the investable areas from a sector and subsector perspective. So we focus on areas on financial inclusion, healthcare, agri, and climate. Right? Because from a theory of change perspective, we wanted to be clear how our capital actually flowed to the funds, to the business, and eventually the scalability and the use of products by the underserved. That's key for us. And, with our global lens, we're able to identify what are the successful business models, the right ingredients for the investments, including ultimately what are the right kind of KPIs and measurement to track.
You have a particular focus on emerging markets. What is the opportunity that you see there that, I guess by definition, others don't, since you describe that there's really a lack of investment or underinvestment in these markets? Most people are staying away. You're diving in.
There are challenges in the emerging markets, and I think it's been also a difficult environment the last few years. But I come back to, I think, our mission and our purpose, right? We're not going to shy away just because it's difficult. Where are the problem statements? And if we don't come in to help manage, where is that going to leave the world in the future? So I think it's sad to say, cognizant that it is challenging, but there are ways that we can manage it as well. I think maybe sharing some of the exciting things. One is really scale. If you look, there are actually large addressable markets in, say, tier 2, tier 3 cities If you look at India itself or China or Southeast Asia or Africa, right? It's a number population game in the rural area, whether it's MSMEs. In fact, I think EM will account roughly, I think, about 70% of global population and 50% of global GDP by 2050. So these are really, really substantial big numbers. But how do you make this work? What's key now versus, I'll say, 15, 20 years ago is because of innovation. What we see now is with data, is with technology. You mentioned, right, on digitization, you have AI, all these developments, that it is allowing us to actually achieve the unit economics and the efficiency, right? Because of the underserved lands, it has to be affordable, right? So you have this different elements to kind of manage. And technology has really allowed you to achieve all this, to get the scale and affordability and profitability required, right? Because we have to be sustainable longer terms. You also need to know your target beneficiary. So with them, you still need to think about distribution. How do you do effective distribution? So anyone who tells me it's only tech, it's not going to work. You need community, you need agents on the ground to go out to really speak to the community, understand their needs, and be the person that you trust. So I think understanding the local context, it's very important. And it's going to be very different whether it's in Africa, Latam, or Asia. And lastly, I think like any other investments is the execution. I think finding founders that you trust who have deep domain expertise, they understand the local context, supporting yourself with aligned cap tables in terms of impact investors, and definitely having exit plans. I think for investing, and you'll probably hear from other investors as well, you have to come in upfront and plan early on exit. What are you going to do from an execution, a value add, and exit perspective? We don't have all the answers, but I'll say I think these are some of the characteristics we look out for. And then how do we work with one another to make sure it still remains successful at the end of the day?
By everything you just described, I don't think anyone would argue with, but it all comes down to execution. So let's talk about Temasik's impact investment process. You've put over 500 million into this space, which is a serious commitment. So speaking from an investability perspective, walk me through how you approach these opportunities and the end-to-end investment process that Temasik goes through when selecting an investment.
And I'll say for the 500 million, that's only for the leapfrog commitment. So I think we're also deploying more than just the 500 million. But yeah, in terms of our process, yes, from the very beginning, we spent quite a bit of time kind of mapping out the sectors and subsectors we wanted to focus on, especially linking to the theory of change we discussed earlier, as well as the kind of landscape of the potential investments, both the impact funds and the companies. So we do proactively reach out to them to get to know them, and it's a long-term relationship, but we do get a number of inbounds, I think, given who we are. We do have a high bar from a returns and impact perspective. So only if they meet our initial kind of hurdle and screening, they then move on to the next stage of due diligence. Maybe on the impact side, so we also have developed our own proprietary impact, measurement approach, or like an assessment tool, leveraging global practices. So we assess every deal rigorously and systematically. There is a minimum score, in order to get through, focusing on 3 dimensions. So one on impact thesis. So applying IMP's 5 dimension, we really see whether the investee's kind of strategy fits our strategy. And I'll say I think this is probably the most important dimension because it reflects the intentionality of the founder and the team. So we spend about a lot of time understanding the founder's motivations, why they do what they do. We do checks on the companies, like do they really reflect the mission, or is it something that they just kind of label? 2, on impact practice, really how do you embed impact across the process? And a lot of people reference OPIM, so operating principle for impact management, which is very helpful. But we specifically zoom into areas of transparency, governance, and kind of reporting, especially on the impact side, to meet our internal requirements. And lastly, in terms of Temasik contribution, really how do we enhance the impact further? So for every deal, we are quite active to see how we can amplify the impact. And I would say I think it is a feedback loop, where we continuously learn and refine our approach and then kind of share and collaborate with others. So that's on the impact side. On the financial side, we go through the same rigor as any other deals in Temasik or kind of globally, and making sure you meet the necessary kind of DD checks. So reputation, governance, viability of business model, and of course, financial returns, right? Ultimately, and making sure you embed impact within the businesses. And I've already shared earlier some of the characteristics that we look for as well within what we look at.
What's the proportion of that universe that you end up allocating to?
Yeah, so I'll say in the beginning, we really wanted to be comprehensive. So we did extensive, we actually reached out and met a lot of people and to really learn from others who have been on the journey longer than we have because we didn't want to kind of reinvent the wheel. It is a funnel. I say because I mentioned because the bar is high. So it does narrow down to a very small, I say kind of percentage from a conversion rate. But now I think having been in the market for a while, we know what we were looking for. So I think we're also being very efficient in terms of where we spend our time, etc. But the bar is high.
Do you have a rough percentage that you end up allocating to from what you look at?
Always small,
Like single digits, right?
but probably single digits. Yeah.
Are you able to say the number of investments, that impact investments you make in a year?
So that's not public. I would just say maybe we have built a diversified portfolio of impact funds. And we're also going to do kind of direct and co-investments. So some of the names, the two strategic partners are Leapfrog and ABC Impact. Some of the other names that we've invested in, whom I think you've spoken to, Quona, Elevar, AXA Impact, just to give you a flavor. So this, as you can see, it's across different sectors as well as geographies, and many more as well. So I think we're quite happy with the diversification and portfolio that we have at the moment.
What I find particularly interesting in speaking with you is that you don't put limits on investments by asset class or country or sector or single name, which is pretty unusual. But I think that's because Temasek owns all of the assets and you're not a fund manager. So your investment horizon has the luxury of being long term because you're investing off your own balance sheet and you're not constrained by things like fund life and so forth. How does that flexibility change the game for you?
That is definitely an advantage for us, having that longer term view. As you say, we're a generational investor versus a typical kind of private equity, right? Where, the clock is ticking, you have that finite, you need to exit within the 4 or 5 years. But that's it. We still also have to meet our financial returns. So we have certain expectation in terms of when we want to kind of monetize the investment. But because of the generational lens, sometimes we can potentially make strategic decisions and maybe hold the asset for a longer period of time, but without kind of changing, I think, the original underwriting in terms of the market returns as well. So it is balanced. It does give us a lot more flexibility, but we still have to stay rigorous in terms of the returns as well.
Then in practice, does that actually influence your approach, let's say, to ticket sizes and maturities and exit strategy in comparison to your competitors? Does it give you an advantage?
No, definitely. I think it does give us the flexibility and the advantage as well. And I think making certain decisions where it may be helpful, for example, within Singapore, within the region, within the community as well. And that's also quite empowering, right? Making the difference for over a longer period of time. It does allow us to see different opportunities that a typical fund may not be able to. I mean, just referring to some of the platforms that we discussed earlier, Gen Zero, Pentagreen, decarbonization, these are quite unique. Having the ability to be part of that, to launch that, it's very exciting. I think it comes back to the nature of who we are. And we try to do that, right? I think we try to be innovative. We try to see, what we need to be flexible, test the markets, push the boundaries. I think, beyond investing work, we do a lot of kind of ecosystem support and building works, which we can share later as well.
Discussing specifically your impact screens, is this an iterative process? And by that, I mean, are you looking for companies that already generate impact but need help or guidance from a business management perspective or a strategic perspective or maybe financial perspective? Or are you looking for companies that look like a strong investment but also have the scope to generate impact or maybe better impact? And you think once they generate impact, this will lead to better returns. Is it one of these first and then the other? How do you approach this? Because that's always the question in impact. Is it love or money?
We get a question a lot, and it's a tough one. And I don't think there is a one size fit all. And what I always say, the starting point is the same. It's together. It has to be hand in hand, returns and impact together. And that's why when I mentioned if we can find companies who then say focus on the end beneficiaries, right? That's their core. The business model aligns both impact and the business. That's when it's most aligned. So I'll say, it's always good to have some of the impact KPIs which are similar to financial KPIs. So it's interlinked. So in difficult times, you don't have to, the founder doesn't need to think, okay, am I going to survive or am I going to do good? It's the same, right? If I grow, I scale the business, my impact will amplify as well. So it's finding the right business model to allow you to achieve both. So if you grow the business, you will create more impact. But that's the challenge. It's not easy. It's not easy to find so many opportunities or business models like that, but they are available in the various markets.
We've already mentioned that you focus on emerging markets and you see opportunity there. But as we know, most investors see emerging markets as particularly risky. You've mentioned that you have familiarity with these geographies and that gives you an advantage. What is that local knowledge that you have that gives you a competitive advantage in emerging markets?
As you say, we are active in the local market, so we're familiar with the local contexts, the nuances. We're lucky because we also have local offices on the ground. So we have offices in India. We have a presence that looks at kind of Africa as well. And then we have partners on the ground. So when we invest in the GPs and the funds, it's really having the extra legs and hands on the ground to help us navigate, right? So, we always use them and ask them to validate, verify, and support us where, in challenging times on the ground, right? So it's not siloed. It's a collective action. And then how do we work with one another to make the best? And generally, I think in the impact space, everyone is very collaborative. I think everyone is very focused on the end mission. So kind of willing to kind of share from a trends and the insights perspective. So I think that's quite key. But that's it. We do also focus on more mature markets. So I think Asia versus Africa and LATAM. And we've been the most active in India. And I don't know how much you've kind of tracked India. It's been very interesting in terms of developments the past few years with more kind of sizable exits, both in the equity capital markets, but also in terms of M&A strategic. So it's setting the DPI and exits that people are looking for. So I think that's quite interesting as well. I think the other thing that we look for is, of course, when we build our portfolio, diversification across the sectors and the geographies as best as we can. So that's something that we do. And I think eventually it's who do we work with? So we, choose the right business models, markets, or GP who have the experience in terms of exit. But in terms of managing the EM, volatilities, whether on the FX side, the situation on the ground, etc., you need to be able to manage the challenges and the nuances there. And that's why we spend so much time, I think, talking to the local team. Right? When we go DD, we'll have dinners, we'll spend a week or 2 days on the road with them, right? So we get to see how much do they know, do they really understand, and can they really manage all this? And lastly, I think you just have to be active and track the investments very closely. I think picking the right founders and investments who are very aligned with your approach that you can trust. And the key is, can you trust them? Because there will be surprises, there will be challenges. So how can you collectively work together if there is a need to, manage the situation and come up with the solution without losing, the focus on the impact mission?
Can you share a story about what you've seen when you've met with a company or some of the end beneficiaries in some of these markets, and how does that relate to the importance of what you're doing professionally and personally, maybe?
It's actually very important for the team to actually spend a lot of time on the ground where we actually, meet the companies and the end beneficiaries in the various emerging markets. So whether it's rural India, Indonesia, or in Africa. So maybe just to share one story in India, we went to Harni village. So this is about a 2 hours drive from Pune in India. And we met this amazing grandmother who was looking after her family of children and grandchildren. So she runs a kirana shop, which sells basic provisions, but she has other incomes. So from dairy as well as onion farms. So actually quite entrepreneurial. But despite that, it's also been difficult for her to get loans. And so through Cybergram, which is one of the company we invested in, she managed to borrow a small loan. So not much. It's about like US $3,000, which she used to kind of buy more inventories. And obviously that actually helped to grow her business. What's even more interesting was she actually hired a group of females in the villages and actually train them to help manage the businesses. It was very, it was amazing to see the strength and the resiliency of female entrepreneurs in India. Every time we do the trip, I think for me personally, it's really humbling and inspiring me to see how entrepreneurial and resilient this group of people are, and actually how our capital is making a difference. A lot of for this underserved families, when you spend time with them, their main hope is so that their children and grandchildren have a better tomorrow. And that's all. It kind of reminds me of what my parents were doing for me as well.
In 2021, you made 500 million commitment to Leapfrog Investments. And I think that's one of the largest ever commitments to an impact investor. And I think you took a minority stake in Leapfrog itself. I know Stuart Langdon, he was on the show a while back. He's a great guy. I really like him. And in general, these are impressive people. What was the thinking behind that level of engagement? Is that to scale? Or I guess another question also is, do you do direct investing or are you always working through funds?
Yes, we do direct investing. And that's the call for us as well. But I think because the team is small, we started with the fund investment side, but definitely doing more in terms of direct and co-investment as well. I guess your question on why Leapfrog. Yes, the first few questions that we're trying to solve in the beginning was, how do we achieve impact at scale? The key is scale, but with financial returns and impact. So I think when we kind of first mapped out the whole universe, especially in EM, there were not many players. And Leapfrog, I think, given their 17 years of experience, in terms of their knowledge for the underserved and the impact thesis, it really aligned with us in terms of the ambition that we wanted to achieve. And I think through a long time, actually, I think the relationship and, is this a party that we trust, that we want to work closely with? And the answer was yes. And hence, we don't do a lot of this. There's only kind of two strategic partners that we really support, one of which is Leapfrog. So, the 500 million was also thought out. We also don't invest. We are a minority investor in the GP. We don't normally do this or others. And we're anchors to their fund 4 and as well as the climate strategy. But I'd say, it has been a true partnership. I think with both sides benefiting. For us, learning from them in terms of their impact approach and investment insights. I think for them, us helping them to scale and take their platform to the next level. So I think it's been quite an exciting journey.
What I remember from speaking with Stuart is they have very specific minimums of the number of people each investment has to benefit. They're looking for scale. They're quite clear about that. And they're looking for big numbers. Otherwise, they don't go in.
And what's key is they don't lose the focus on impact, right? I think the worry and challenge is as you get bigger, does that mean your strategy will change? Does that mean your impact will be diluted? They have remained focused in terms of what they were trying to do and go deeper as well. I think that's really impressive.
And then you also built a relationship with ABC Impact. Tell me about that.
Yeah, so we have two strategic partners. The other one is with ABC Impact, and that's quite unique. So together with Temasek Trust, which is our philanthropic arm, and the Temasek ecosystem, we wanted to demonstrate that you can get scalable impact investing in Asia. Also, not as many kind of impact GPs or funds in Asia of scale. So we are anchors to their two funds, and we work very closely from a deal perspective, impact, and thought leadership. So they're tracking very well. So we're always encouraging kind of different LPs to get to know what the team is doing in Asia.
But how does ABC complement what you're doing with Leapfrog?
Firstly, the space is large. Coming back to the opportunities and the gap. And I say within the impact space, everyone is very collaborative, right? I don't think there is a clear overlap in terms of the areas that they look at. But if there are, in fact, we could all work together. So there have been instances where we will work with ABC, we will work with Leapfrog, or collectively, all together. I think that's the beauty of the impact space.
Nobody knows everybody, huh?
No, and the space is big enough, right? We need more people to come in fact.
I'd love to hear about some of the companies that you've backed. Could you give me some examples that demonstrate this investment process now that we've been talking through, just to make it real to listeners?
So on the direct side, mentioned about Savagram, which is a company we invested in. And the challenge it's a company that provides kind of financial and productive solutions to rural households in India. And the challenge in India is really the lack of formal credit history. So about 90% of rural India do not have access to formal financing. But there are about 200 million of rural households in India who are quite resilient, as I mentioned earlier, right? So they have different incomes from the informal economy and social aspirations. So what Cybergram does, is to understand the challenges and opportunities for rural India and customize the right products and solutions. So whether from underwriting to controls to the approach, kind of leveraging high tech and high touch. The two founders are super impressive. They have deep domain expertise and many years of experience having come from ICICI Bank and Fullerton. So through Cybergram, a lot of the rural households then get access to products and services which they previously didn't have. So for example, loans to grow the business. So during DD, we get to validate a lot of these points. But post investments, we actually work very closely with the company to be able to support them on their strategy and the execution. On the fund side, maybe on Leapfrog Fund 4, which is focused on financial inclusion and healthcare. So when we did the DD on it, we really found, you've spoken to Stuart, we found the team really knowledgeable about the local, industry and the context. And they all believe in the mission of returns and impact. And that's quite rare to find. What's also very unique, I think, it's the value add they bring to the companies post the investment. So they have, for example, the customer experience capabilities, talent accelerator, impact, and data. But with all deals, we do identify where and how we can support them post the investments. So how is Fund 4 doing today? So they just closed the fund, about US 1.02 billion with kind of basic commitments and co-investments. On the impact side, as you've mentioned, actually, they aim to reach 100 million of emerging consumers. And so far, they've already reached 24 million. And from a companies, they've invested in 5 companies. Amazing growth last year. And just to share 2 examples, one is Sun King. I'm not sure whether you're familiar with them, but they're the world largest off-grid financier, where they enabled like 118 million people to access to solar energy. So a very interesting business model. And Redcliffe, which looks at kind of diagnostics in India. So very exciting, I think, for both the companies. I want to caveat, it's still early days, but from a returns and impact perspective, we are on track. So I'm very excited to see how the development will go.
Is Sun King in Africa?
Yes, but they're growing presence in Asia as well.
Are there key KPIs that you monitor these investments with?
Yeah, so we do, for each of the investment, we do identify what are the key impact KPIs that we want to track, right? So, specifically, what is the contribution either positively to environment, socially, or in fact, sometimes both, right? So we do track a number of KPI at the portfolio level, which we can aggregate, but also at the sector level, where we have data that shows the depth of the impact. So just to give a few examples, on the portfolio aggregate level, we track KPIs like customers reached. So it ties to in terms of the number of customers. And in particular, we also try to understand what is the level of underserved and lives touched. We look at the GP contribution, the amount of capital that is raised, the number of companies that they supported, to employment data and diversity.
Global Delta Capital, we're a long-only emerging and frontier market investor. We are able to run a series of specialized strategies around country-specific implementations. But our core offering is an emerging markets all-cap strategy, both with and without China. Our investor base is comprised mostly of institutional investors, including family offices. We currently offer commingled vehicles as well as separate accounts.
You have emerging markets all cap, you've mentioned, then there's an emerging markets small cap equity.
So the strategies we offer fall across the emerging market spectrum. Our live strategy is an emerging markets all cap strategy. We can offer an ex-China sleeve or a variation that includes China. And we have capabilities to develop all variations within emerging markets, whether that's country-specific strategies, emerging markets, small cap, frontier. But the live vehicle we have today is in the emerging markets all cap space.
And is that one fund or is that 2 funds?
We offer one fund and 2 sleeves within the fund.
Is that open-ended or closed-ended fund?
This is an open-ended fund. We offer monthly liquidity.
Do you have other stats?
Yeah, sure. Happy to share some overview of the portfolio. Emerging markets all cap strategy benchmarked against the MSCI Emerging Markets Index. Because we cover such a breadth of securities, like I say, 15,000, and we're looking for outsized inefficiency, we tend to find a lot more alpha opportunity on the small cap side of the spectrum and off benchmark names, whether those are companies that are not included in the benchmark, or if it's countries that are not included in the benchmark. So a pretty high active share on the order of 90%, and significant exposure to the small cap side of the spectrum relative to benchmark exposures. Across countries and regions in the emerging markets, we're highly diversified. We see opportunity at the stock level across regions. At the moment, we're certainly favoring Asia and happy to speak to some of the rationale there. But we see incredible opportunity across the Gulf, across Eastern Europe, a little bit more muted on Latin America at the moment, although there are some stock-specific opportunities there that are interesting as well. Tend to be very diversified across sectors and quite dynamic. I do think again, I've mentioned the SDGs as carving out a pathway for global growth and secular themes for the next couple of decades. So at the sector exposure level, where we have some themes that are particularly interesting are on the consumer side, the technology side, and sustainable infrastructure.
What is your total AUM?
Managing approximately $100 million in assets.
What's your theory of change and your investment philosophy behind your portfolio construction?
In terms of portfolio construction, I'll tackle this both from an alpha generation perspective as well as from an impact generation perspective, right? So what makes the asset class so interesting is there's outsized opportunity for alpha and for impact. And these two themes are mutually beneficial as opposed to concessionary to one another. From a portfolio construction perspective, again, we're using a systematic approach. We're using effectively an optimization method, and the objective function, the goal, the objective is literally to maximize returns, subject to transaction cost and subject to risk controls. So from an alpha perspective, our objective is to truly maximize the return opportunity, which of course in emerging markets includes some significant diversification of risks at the country level as well as stock level. On the impact side, the theory of change and the thesis around what we do is multifold. Number one, we see sustainability measures as alpha generative. We see that by investing in companies that are well governed and have strong environmental and social practices across the globe, those types of companies will outperform. In the emerging markets, where there's more dispersion on these types of themes, we actually see the payoffs to sustainability factors to be twice as high. And so investing in companies that have strong practices with respect to these sustainability themes in and of itself is a way to improve returns. However, our strategy is about more than improving the returns of the company for our investors, but also by delivering some level of impact. And so from an impact perspective, our objectives are twofold. One is to provide that financial additionality, which I spoke about before. So to find companies that are capital starved, that have needs for more liquidity, that are performing well with respect to sustainability, or I know ESG has become a four-letter word here in the US, but these ESG factors, to be able to fund companies that not only have strong ESG practices, but are also developing SDG-aligned solutions. So that to the extent we can be a funder of those companies, that's delivering a level of impact with respect to financial additionality. But the value additionality comes through our stewardship practices. And I think stewardship practices, as we talked about in the case with Romania, pretty significant in emerging markets where we can drive that system level change and improving disclosures, improving transparency, improving accountability across parts of the market that are looking to really evolve into the global capital spectrum of flows.
Let's be clear, you're a quant fund, and this integration of sustainability and ESG factors, I guess, depends on having good data and somehow incorporating all this into some kind of model here. This is kind of unusual being applied towards emerging markets and frontier markets where you got pretty thin markets. So let's try to drill down a bit more in the weeds. I'm going to ask you to explain what Quantamental investing is. And I remind you, you're talking to a guy whose girlfriend did all of his statistics class homework for him in university. Okay? So Easy on me.
I don't want to make this overly mystified. I see the quantitative approach that we utilize as simply an objective implementation of fundamental themes. So a fundamental investor wants to invest in companies that have good growth prospects, that have strong financial statements that prove that the company has the balance sheets and has the management quality to support that growth. So that good growth, strong quality companies. The valuations of these companies are attractive, meaning that there's some upside in the stock price. And then finally, there's some technical support, that this is the right time to buy into one of these securities. So the systems that we're using have basically built factors or signals along those themes. So we, just like fundamental investors, are looking to invest in companies that have good growth prospects, strong financial statements, strong management teams, attractive valuations, and some support for the stock price. And again, the systematic approach simply tries to objectify that. And by using this objective process, it gives us, I think, a real significant advantage in investing in emerging markets. Number one, because we can target a breadth of opportunity. If we've systematized the analysis, we can create that framework and run it literally across every single stock that prices. So every stock in China, we've got a forecast for. Every stock in Vietnam, we've got a forecast for. And that's imperative. Again, having coverage of the smaller cap side of the spectrum gives us access to information of stocks that other investors aren't following, and therefore likely have a more attractive mispricing characterization. Likely there's more upside in those stock prices. Another hurdle in emerging markets, of course, is foreign ownership limits and transaction costs, liquidity, these operational hurdles that are very real. Having a breadth of coverage enables us to tackle those hurdles. So this objective approach enables us to cover a very broad universe of stocks. Number two, it enables us to be very disciplined. So I'm sure your listeners are hearing about us investing in emerging markets, and it often sparks a lot of fear. I mentioned EM is mainstream in every way except investor allocations. I think the reason is investors are concerned about the risk profile in emerging markets, and rightly so. Country by country, there can be tremendous volatility within countries. And I said, emerging markets are often in the news. It's often not for good reasons. It's often to highlight risks. And so having a disciplined process that tells us, this risk has been overestimated, or, the country looks fantastic and the secular themes are so exciting, but that's been priced in, and this is a good selling opportunity. Having the discipline that comes with a quantitative approach in markets that can be very volatile is an advantage. And then thirdly, on the, why a quant approach in emerging markets? And again, I get the skepticism, can you really apply data sets to companies where you haven't talked one-to-one with the management team yet? How can that be effective? Trying to walk through the value of a broad universe, the value of a disciplined approach, and finally, the value of using this holistic, or what some people call a multi-factor process. The fact that when I'm evaluating a security, I'm not only thinking about what's the growth prospect and what's the financial statement support and what's the company governance like and what's the valuation, but we can layer onto that what's our macro view for this market. We can layer on top of that what is the liquidity profile, what's the transaction cost profile. To do that across 15,000 stocks, it's simply not possible in fundamental space. That's kind of the high level on why a systematic approach and how a systematic approach works.
How did you build the model?
So again, I've been in this space for about 15 years and have my own background and history in running systematic strategies. And I've just had the tremendous fortune of pulling together a team that has incredible skill sets. I mentioned my team is a team that I've worked closely with in the past, and they bring tremendous skills in accessing data and cleaning data and developing factors that are predictive of return, combining factors, weighting factors. Each of these measures requires some level of expertise, and I'm just honored to have a team that brings that talent to this organization.
It's hard to contemplate how you have one systematic model which is localized, but flexible enough to accommodate all the different emerging markets because they're so different.
Yeah, no, you raise a really important point, Scott, around the importance of localizing models. When I began my experience in systematic investing, emerging markets was a bolt-on asset class. It was a very small asset class. It was considered completely opportunistic. It wasn't mainstream in any way. I think currently I've said over and over that investors are under allocated to emerging markets. I'd say, typical allocation seems to be on the order of 5 to 10% of an investor's portfolio. When I began investing in emerging and frontier markets, it was entirely opportunistic. It was, below sort of the levels I just mentioned. And my experience over the last 15 to 20 years, and part of what led me, to found Global Delta, is that these countries have truly emerged. Back when I was launching the China Fund, one of the most common questions I would get is China even an emerging market? Like, hasn't it reached developed market standards? Young people in China today have never known a life of poverty. Like, what is it that makes it an emerging market country? The reality is, I've said this before, the breadth and scale of China relative to the US. China and India each alone have as many securities as the US does. And you think of how many US specialists there are. My view is not only does emerging markets stand alone as an asset class and need tailoring for the investment strategy, but country by country, the dynamics are so unique. What's driving China is night and day different from what's driving India. And so what we're looking to bring here at Global Delta is not only a strategy that's specialized for emerging markets, but brings specialization on China-specific drivers, India-specific drivers, the Gulf, Latin America drivers being unique as well.
Do you have a split between the fundamental versus the quant side of your investment process?
Yes, you mentioned the Quantamental. When I hear Quantamental, sometimes I bristle because it means different things to different people and often has a negative connotation. But I think it's such a popular term because it speaks to the importance of both sides. And we're certainly believers in this. I mentioned all of the strengths of a quantitative strategy, the breadth and the discipline and the multi-factor approach. But of course, there are some instances that quants can't, that models are not equipped to handle. I was investing in Argentina when Christina Kirchner started nationalizing businesses. Literally, she would just take over a company overnight, sending the value of that company to zero. So the value for stock investors was literally wiped out. Fortunately, there aren't enough examples in history of countries that keep nationalizing, or readily accessible countries that keep nationalizing businesses. And there's certainly not a robust sample of companies that have been nationalized. So how do you build a statistical model around nationalization risk? You cannot do it robustly. There just isn't enough sample. There's not enough examples to work with. Similarly, what's happening with China in terms of the geopolitical risks, in terms of the market interventions, these themes can't be modeled because there's not enough history to develop a robust enough, a statistical assessment. The SDGs I've talked about as a roadmap for what secular growth will look like. That's a forward-looking theme. So how do you back test that? I think requires some innovations and sort of the mathematical tools that are applied. So we at Global Delta, and I think effectively all quantitative investors, you're making judgments, you're making assessments. It's man that builds the machine or woman that builds the machine. The assumptions that are put in at the front end just are really critical. That's ultimately what drives investment capital. I'm fortunate on our team not only to be surrounded by individuals who have a very robust background in quantitative and statistical tools, but our team also includes experts that live in the emerging markets, bring local expertise to our investment strategies, ensure that the models are built to account for these secular themes. And, we see the importance of stewarding the process. If the models are telling us to invest in a country where we just see outsized risk and we know the models are not equipped to account for that risk, we reserve the right to override the model and influence that judgment or discretion.
Do you have a distributed organization or is it all in Boston?
Yeah, we were born in the pandemic, as you mentioned. For late 2020, we got the founding paperwork in place, and we've been building over the last couple of years. And so that's enabled us to build an entirely cloud-based environment and in a distributed environment. So headquarters is in Boston, but we're based all over.
How many people do you have on your team?
We're 11 people in total.
Let's move to the sustainability side, which you've integrated into this systematic modeling. It's difficult enough to get reliable sustainability data in developed markets. It's just got to be even more difficult in developing markets. So where do you source your data from, and how do you ensure its reliability in developing countries?
Well, to be clear, before I answer you with great conviction around the strength of our data sets, I certainly want to clarify that is part of our theory of change, right? Part of our objective is to be stewards, to call for more transparency and more standardization, and to really support companies in their journey toward better data, that ultimately more informed data or more transparent data will make for more informed investors and therefore greater pools of capital that can invest in these companies. So I think the case for companies, industry groups, regulators to adopt these transparency practices is clear enough. We've certainly seen adoption in sustainability stewardship codes across emerging markets, but there's still a journey, that needs to be taken to adopt these methods. So in the interim, how can we be comfortable with the data sets that we utilize? I'll start by just saying I do agree that country level data can be spotty, can be limited. Company level data can be quite robust. And I alluded to this before, that as companies are looking to come to market, some of these disclosures are just unparalleled, even relative to developed markets. I'm thinking specifically with respect to the SDGs. So many companies and many countries in the SDGs receive funding. They receive multilateral funding that is aligned with the SDGs. So they've got a different reason to be transparent and to disclose with respect to SDG alignment that is truly tied to their sources of capital. So we actually find information sourcing on the SDGs to be robust enough. And I would say that ESG, environmental, social, and governance data in emerging markets, probably better than most people expect it to be. When I say better, I mean in terms of coverage, governance data. There are many, many ways to measure governance. Some of the tools that we think are highly correlated with traditional notions of governance are just readily accessible. So we find very high coverage of core governance measures. With respect to labor practices, with respect to product safety, with respect to many notions around environmental considerations, company reported coverage is okay. And we get a lot of value out of utilizing alternative sources to augment that data. So parsing headlines, parsing data from NGOs, using natural language processing. These are systematic, data-driven tools that are really effective in terms of extending our coverage. So overall, we find that coverage is again, greater than what investors think, especially by the companies themselves. If you're looking for a parsimonious set of indicators, and augmenting that through systematic means gives us sufficient coverage to make an assessment of companies from a sustainability factor perspective.
Tell me how you construct your portfolio, your end-to-end investment process, what that looks like. And I guess I'd like to start with, how do you define your investment universe? And then it's on to the screening process, both financial, non-financial screens.
Happy to do a process overview. Excited to. The investment process, you mentioned Quantamental. I'd say it begins with a fundamental look. It begins with understanding what are the secular drivers, what are the mega themes that create opportunity today. And I've walked you through many of these, which countries we see opportunity in, what are the drivers, the demographics, the SDGs. Ensuring that these types of signals are built into our process at the front end enables a more streamlined process downstream from there. So the process really begins with kind of that fundamental assessment. At that point, we have a model effectively with a set of about 20 signals that we've researched that we believe are predictive of forward return. And they fall into the categories I talked about before. These are signals that tell us, what's the growth potential for these companies? What do sell-side analysts think? What's their history of earnings growth? What is their alignment with SDGs? So a number of growth-related signals, a number of signals I talked about before. What's the financial strength of these companies, the management quality? What is the valuation profile of these companies? We'll look at this through a sector-specific lens, knowing that valuation by sectors uses different tools, and the technical side as well. So we're doing, again, the first step is to have that secular view. The second step is to define the set of factors that we're going to evaluate every company on. And this model incorporates not only what is the factor itself, but what's the relevance of that factor within that country. So you mentioned localizing before. China tends to be a very sentiment-oriented market. Africa tends to be a longer traded market. Liquidity is harder to come by. Those value factors are very, very effective at forecasting returns. So we'll weight these signals in a way that's company and country and sector specific. And the output of that second step of evaluating the stock on every one of these factors is effectively a forecast, a view that tells us our view for, tells us our outlook for the company relative to every other stock in our 15,000 stock universe. What is this company's performance likely to be? And again, it's based on that holistic assessment of company fundamentals. So we've got, at this point, a forecast for every single stock in our universe. We'll overlay on that our forecast for its market. What's our outlook for Brazil, for Nigeria, for Vietnam? We'll overlay that macro view. And it gives us now a single figure for every company that includes a macro view on the forecast for that company over the next 6 months. What are the returns likely to be? Highly systematic approach will take that forecast and utilize an optimizer. I mentioned this before, where our objective in building portfolios is literally to maximize returns subject to transaction cost and risk controls. So you mentioned before screens. We have not screened out any company at this stage because of some sustainability-based consideration or any other. We have evaluated every company on its SDG alignment, on its governance profile, on the climate technologies that it's utilizing. So we've incorporated this signal across the board. But in portfolio construction, we're using that single forecast for every stock, asking the optimizer to maximize returns, applying stock-specific transaction cost, ensuring that there's risk controls at the country level. In emerging markets, greatest source of risk is country risk. So ensuring there's ample country diversification, sector-specific risk controls, controlling for size, controlling for beta, controlling for kind of some of these known measures. And of course, at this point, ensuring that we're not investing in companies that have human rights abuses associated with them, that are not aligned with the UN Global Compact. We won't invest in tobacco producers. We do ensure that the portfolio is future fit in that it's got a lower carbon profile than the benchmark. We see those types of measures as really risk controls. And the output of that is what is deemed to be the optimal portfolio. We will have myself or another portfolio manager or researcher ensure that portfolio, that trade list effectively, aligns with fundamentals, aligns with our market views. And then that's a portfolio we look to invest. We truly believe in these systematic methods, not only to forecast returns, because we've informed the model with what we think are the return drivers, but also to utilize discipline to make the right calls on this is the buying opportunity and this is the selling opportunity.
What is your average hold time for stock?
Yeah, it certainly changes by market. Like I said, China is a much faster market than the African markets. It's kind of a case example. So it will vary by markets. I'd say on average, it's about 12 months, and the range is somewhere between 3 and 24 months.
How do you measure impact in the end from your various investments?
Right. That's one of the sort of perennial objectives of being an alpha and impact-oriented investor is how do you report this, not only to our investors, but also to ensure that we're prudently managing the strategy. One of the benefits of using a systematic approach in the sustainability space is measurement. We've measured on the way in. We know on the way in what are companies' alignment to the various themes I've talked through. So on the other end, once we have the portfolio constructed, again, what I think is pretty novel and exciting for a systematic investor is the ability to show what is our exposure to these themes, just like we show our exposure to value or our exposure to growth. We can show our exposure to these various ESG signals. And more importantly, perhaps, we can show the contribution. So just like in a traditional Brinson report, you can see how much exposure did you have to China and how much did that pay off for you. I think most systematic investors can say, how much value do you have in your portfolio and how much did that pay off? Similarly, in our strategy, we can say, well, how much climate alignment did we have? And was that rewarded by the market over the last whatever period, 3 quarters, 6 months, last year? To be able to show the exposures, the allocation effects, the stock selection effects, and the contributions, I think is relatively unique. Now, that's on what I consider kind of the old school. I know SRI is where we all started, exclusions-based, and the movement was toward ESG investing, thinking about what are these risk factors or alpha factors, that ESG integration movement. I think we're still there, quite honestly, as much as people don't want to say the word. But as a systematic investor, to me, that feels like a nut that can be cracked somewhat readily, that if you've got good data sets, you know how to utilize the data sets, you can do the reporting on it. The next stage in the sustainability movement, I think from SRI to ESG, it's really around impact and around that case around intentional investing. And I do think on the impact reporting side, there is no standardized approach to reporting just yet. We do look to see, to ensure that our alignment to the themes we're targeting is there so that we are SDG aligned, for example. We heavily track our stewardship activities to ensure that the stewardship collaborations that we're involved in are progressing in line with our objectives. And ultimately, I think this is a space that continues to evolve, and we are really pleased to be early movers in the impact reporting space.
I think your entire thesis is predicated on discovering undervalued opportunity in the emerging frontier markets. So tell me how you discovered the next great thing in Saudi Arabia.
Yeah, so it's fun to talk about some of the countries that we've had meaningful exposure to and how that's played out. I mentioned China a while back and the ability to launch the China fund while it was going through not just the trade and the tech war, which was less exciting. The more exciting part of it was the liberalization and the fact that this vast, inefficient market was coming to market. Saudi is almost that story all over again, but perhaps, ironically, a more successful version. I started covering Saudi Arabia in 2010, 2011, 2012. The market was entirely closed to investors at that time. UAE and Qatar were just on the minds of investors because it had, Dubai obviously had quickly risen as a financial capital. It was a well-recognized stopover for international travelers. I'm sure you've been through Dubai many times, Scott, your journeys across the globe. And at that time, those two countries, UAE and Qatar, were upgraded, or were announced more specifically for an upgrade by MSCI from frontier market status to emerging market status. This was 2012, 2013, and it was an incredible event for frontier and emerging market investors. It was the first time in MSCI's history that they had ever upgraded a country from frontier to emerging, and the results were incredible. So UAE in particular, from the time that MSCI announced the event to the time that they implemented it, there was literally a 99% market return. So investors who were in UAE at the time of the announcement, who stayed in the market, pretty much doubled their investment in a 1-year period. I thought this was incredible. I'd been following the trend for some time. It was the first time MSCI had ever made that upgrade, but S&P, another major benchmark provider, had done it in the past. And it was a trend that I was following and really excited to see it realized. But I was covering Saudi, and Saudi was entirely different. UAE was modernizing so quickly. Even Qatar was had just been awarded the World Cup and looked to be kind of a leader across the globe, a cultural icon of sorts. And Saudi was kind of still stuck in the distance. I put boots on the ground for the first time in 2012. I had a 1-year-old at the time, and I felt it was important to visit this market. I was so intrigued by it because it's huge. It's much more significant than the rest of the Gulf markets. In fact, than all of the other frontier markets combined. The liquidity of Saudi was more than twice the liquidity of all of the other frontier markets combined, which is why it was never part of the frontier markets index. So I was really intrigued by the breadth and the scale of this country. I had a 1-year-old at the time, really wanted to visit. Thankfully, my husband has a travel bug. He agreed to come along as the traveling nanny. Not the nanny, but the manny. He took care of my son while I visited companies. And perhaps even more fortunate than getting to bring my family along with me was I got to get into the country. Turned out at that time there were no tourist visas whatsoever. And certainly even on a business visa, a woman couldn't enter alone. A woman needed to be escorted. So thankfully, my husband came along and I could get into the country. I was appalled. The state of development aligned with my experiences in India, what we were talking about early on, rural India. It was nothing like Dubai. Even the sanitation levels were consistent with what I had experienced in rural India decades ago. Despite this, I just had this notion that change was underway. I could see the Gulf liberalizing. I saw the scale of Saudi. I heard about expats coming into the country, and I was really intrigued to learn more. It continued to be a hurdle to be a woman in this country. I had to wear the abaya, the headgear, and the full dress. And in Saudi, it's very different than in the rest of the Muslim world, where it's not just a headscarf and a covering, but it's literally black. It has to be black. In other parts of the Gulf that require standards like this, you can wear purple, you can express yourself. But in Saudi, it's literally black. And it was repressive, right? To feel covered all the time. And I'm not very skilled at wearing the headscarf. It was embarrassing to be a woman. And often I would visit companies and I would be singled out. Why is she here? And does she need to be here? And doesn't she know that the women work in the other office? But of course, the leadership was in this office. And once again, thankfully, I was always escorted by a broker who happened to be a man. And so I would find my way into these meetings. And I truly heard, being there on the ground, what I envisioned to be real was coming to life, that expats were moving there. They were watching the liberalization of the UAE. They wanted to modernize. They wanted to become part of global capital flows. They were opening up the market. In fact, they moved the weekend schedule. So the Gulf is Friday, Saturday. Saudi used to be Saturday, Sunday. They moved the weekend during this period while they were talking about upgrade. Can you imagine just changing the weekend? It's no longer Saturday, Sunday. It's going to be Thursday, Friday. They changed their weekends. I can't say with certainty that it was because they wanted to liberalize economically, but I think directionally that's in line. They brought NASCAR to the country. They brought Frozen as one of the first movies that they allowed people to watch in a public forum. This was a country that was liberalizing not only financially, but socially as well. And this was at the time, a really tough position to take because, of course, the headlines were terrible. Khashoggi was all over the headlines, and MBS, this young, charismatic leader, was made out to be certainly a villain, and there was real headline risk that validated that thesis. But my view is this is a market that's going to open up. Again, it brings the scale of more than twice the liquidity. It's going to follow in the footsteps of its other Gulf neighbors. Saudi certainly doesn't want to be the laggard relative to UAE and Qatar. I took the uncomfortable step of making an overweight to the country in my portfolios. And time again, Saudi took those steps toward liberalization, opening the markets toward foreign investors. They did the unthinkable when they liberalized Saudi Aramco, which was once considered the crown jewel that would never be IPO'd. Largest company in the world was IPO'd. And like I say, not only did it pay off from a financial perspective, but it just speaks to the incredible social liberalization that's happened there as well. One of my colleagues is Saudi-based. And she talks about women in Saudi Arabia, these, repressed women that we read about and that we can often sympathize with. They've got tattoos of MBS on the back of their necks. Just experiencing this incredible social liberalization. So that's an example, I think, of how, systematic tools can help us pick the right stocks, but you need people on the ground. You need people to understand these markets to pick the right country.
Tell me why specifically investing in emerging market fintech and financial inclusion represents a solid investment opportunity versus a more diversified impact VC fund without all of the fintech and emerging market concentration risk.
The way we think about the focus and diversification is the following. We believe being focused on fintech, which actually is a very broad category once you unpack it a bit, is actually really our strongest competitive advantage. We are allowed and able to see and study why do some fintech models fail while others succeed? How do you adapt certain fintech business models to different types of regulatory environments? How can we cross-fertilize? And that's where the diversification comes in through geography. So we're focused on a sector. And again, we can unpack a bit. There's many elements to that sector, from payments to lending to neobanking to insurance to personal wealth management. So there's a bunch of sectors and business models, which is one way the diversification comes in. The second way is geographically, because we're not just in Brazil or India, we're in Mexico and Indonesia and South Africa. So that diversification also provides multiple paths to liquidity and multiple counterbalancing effects if there's a macro shock in one of those. So we think it's actually a very good recipe of focus and specialization and really becoming domain experts with diversification in terms of business model and geography. If you look at venture firms globally, including ones like Sequoia or Excel that have been actively involved in emerging markets that we work in, like India or China, as well as local VCs like Kazakh in Latin America or Partech in Africa, their highest percentage, if you look at their portfolios, is fintech. So I think there's a real empirical basis for focusing on fintech.
Explain Quona's theory of change and the problem or the problems that you're trying to solve.
We believe financial services, specifically inclusive financial services, is the single most powerful lever to create economic opportunity for underserved consumers and small businesses. Quite simply, it becomes the oil that greases these economic engines and is so fundamental to be able to do basic things like educate your children, find a job, build a business, improve a housing stock. So again, the things you think about wellness or wealth building activities at the most basic level, financial inclusion is a critical piece of that. So our belief is by radically improving access and quality to financial services, we can become the springboard broadly for local economies.
Can you walk me through the end-to-end investment process that you go through when selecting an investment? And maybe you can start with just how do you go about defining your investment universe?
So we are very thesis-driven at Quona. We get together as a team every Monday for 3 hours from Mexico to Singapore, and we go through both our portfolio, highlighting important updates, as well as our pipeline. And that's the opportunity where we begin seeing trends. So we begin connecting the dots as we see certain themes and certain business models begin to emerge. So those theses really drive how we go and look for new entrepreneurs and new business models. So it's always with a core area of focus. Usually there's 4 or 5 thematics that we're looking at any one time, and they're continually refined at these Monday morning meetings. So idea comes up, we're meeting with entrepreneurs because we are locally based. So we're continually having coffee and even meeting with entrepreneurs that might not be part of our portfolio. We're very much ecosystem builders and really want to support even others that might not be companies of Quona. So from those many interactions with entrepreneurs, with our co-investors, we will bring the ones that bubble up to the top. We usually vet them as a regional team. So there's an Africa cross-border team, a LATAM team, and an India team. We'll vet them, and the ones that we find most interesting, we'll bring through a pre-screen to these deal watchers. And sometimes we'll bring ideas just to kind of see and test out and have them be shot down. So sometimes it'll be sort of the formal stage one. Other times it'll just be to elicit a discussion and test whether a thesis needs to be refined or evolved. So that process of iterative testing and refining happens across 3 stages, where you do diligence and develop a term sheet, again, interacting with your co-investors and the entrepreneur. And then the final diligence is the more deep reference checking and what I call corporate hygiene, making sure taxes are correctly paid and financial services properly summarized before an investment. So it's an iterative investment that has multiple stages.
I'm going to back up a little bit back towards the investment universe, or on the front end of this. What do you look for in an investment? What makes a company investable for you? And we'll get to impact shortly, but at this point, I want to know more from a non-impact perspective, if this makes sense, and more from a financial return perspective, unless it's an iterative process for you that starts with impact. Things like quality, scalability, or the financial metrics that you look for before you just say, oh, well, that doesn't fit. How do you refine your investment universe?
Great question. So we start with market and adjustable market. So it's not a coincidence that our 2 largest markets are Brazil and India. There's an enormous adjustable market. Both of them have a very high concentration of banking sector, which means there are tens of millions of people who are unbanked. So this idea of an addressable market that's really a blue ocean opportunity, and understanding what are the pain points, what are the specific areas that really provide an opportunity for a technology-enabled financial solution. So it starts with the market analysis. Then we're going to talk about entrepreneurs and individuals, because it's so critical for our success to find entrepreneurs that really understand how to navigate a complex lending environment or complex market environment, how to deal with other challenges of an emerging market and building a team. But then the business model really is, maybe the fundamental part of your question, where we're really both looking at what's happening in US and developed markets, but sometimes there are antecedents that become very relevant, like personal financial management, for example, the wealth fronts or betterments of the world, and understanding are there applications in our world, or payments. We've done a lot on the payment side, for example, a company like Square or iZettle, which brought payments down and digital acceptance down to a very, very small business level. So we'll look at business models and tease out the applicability and actually look for examples, because often the entrepreneurs themselves are bringing models that are modeled after what they've seen in other markets. What's exciting about the analysis that we're doing on these business models, and again, another part of the financial case we need to make, is understanding that technology really changes the physics of a business. The unit economics of some of these companies are transformed by technology, because maybe you're able to engage a customer digitally versus having to go and find them, kind of feet on street. The ability to integrate with other financial services, that's called embedded finance, which also changes the revenue picture. It brings in multiple sources of revenue and creates a very sticky relationship with the customers. So there are many aspects of understanding the dynamics and the product market fit, not just the business model, which are categories that really drive what we bring to committee as proposals for investments.
And at what stage do you conduct the impact-based assessment?
So that's almost the first filter. So the first question with any of these business models is, are they radically improving access and quality of financial services to the unbanked? If we can't make that case, it won't go past the first stage. There has to be a financial inclusion thesis in terms of, again, either who you're serving, trying to bring in people who are on the margins and have them access to a financial service that wasn't available to them before, or on the quality piece, which is bringing new financial services, maybe to people who have some banking services or others who do not. So quality has to do with affordability, product breadth, the customer service, like how quickly you receive or how simply you receive a financial service. And the last pillar of our impact analysis is what we call markets. And there we're looking at how much capital is attracted into the market, or how many copycats it engenders other indirect impacts. So access quality markets are the tools we use to verify that a company is actually having an impact.
So the very first cut is an impact company in the financial inclusion space
Exactly.
before, no matter how good the financial KPIs are.
Yes.
That's the very first step, right?
Exactly. And in fairness, we use a qualitative scoring of high, medium, low that has numbers behind it. So there are some cases that are more financial than impact, but you have to show and measure the progression towards, for example, maybe a smaller percentage of their customers are unbanked. So you have to show that there is actually an intent and a strategy to grow the impact over time. Whereas in other cases, it's a very, very high impact. And there you're just trying to scale the company.
And how do you typically structure your investments?
Very like a classic venture investment. We're using convertible preferred, safe notes, very typical venture investor, very typical NVCA, National Venture Capital Association approaches. So very clean vanilla.
All right. And ticket size, roughly?
1 to 5 million for an initial investment. We do have what we call a toehold strategy, which can be sub 1 million. It's really to, as the name implies, kind of get a seat at the table and then get more involved if we like what we see. And then we have enough capital to do follow on. We can do, kind of 8 to 12 million over the life of the company if it is one of our successes.
And what's your target return?
We're in the 20% net IRR return, about 3x MOIC, depending on how you calculate.
And your holding period, typical?
We have 10-year funds. We have the +1+1. We're usually, we've had exits during the investment period, but typically is that we're exiting in years 5 to 10.
Now let's drill down on impact. Quona's known for its impact approach, and it's often described as a pioneer in the impact space. So tell me, how do you think about impact?
Yeah, so our key measures of impact are 3 dimensions that we are tied to our theory of change. So it starts with access. We measure and count clients, both total number of clients as well as the percentage of those that are underserved. And that underserved definition is done based on demographic data in the country, corroborated with local partners and ecosystem players. And we measure as a percentage of total for every company that we serve. The next big pillar is quality. And that quality metric has, again, a number of subcomponents: product breadth, affordability, delivery time, customer satisfaction. So there's a number of areas that we're counting, not just how many, but how well is a financial service being delivered. And the third measure of impact is this indirect measure called markets. And there we're measuring everything from how many people are we employing, how much capital are we crowding into these markets, are there copycats or demonstration effects. We even sometimes track what is the market price for this good, and how much is this one company influencing the market price. The last one, obviously, attribution is more lighter, but we do want to track these indirect impacts as well.
So how does Quona conduct its impact assessments, and what KPIs are you looking at from an impact perspective?
It's actually in our term sheet. We make a commitment at signing the term sheet that in addition to financial statements, you'll provide monthly dashboards that have financial, operating, and impact metrics embedded. We could report on them to our LPs every quarter. So when you see a company, you'll see an update, and it will include the impact update as well as the financial update. And then at the end of the year, we will do an assessment where we rank companies based on how much they've progressed and as well as how much they have fulfilled that impact thesis that we set out in the beginning. The other thing we do to corroborate our impact are twofold. One, there is now a global standard called the Operating Principles for Impact Management. That is a set of guidelines that impact investors subscribe to. That's a 9-step process, which ends with an external verification that actually you have like an audit almost, if you will, that they come in and they evaluate. Are you truly measuring? Are you really reporting correctly? Are you following up with your companies? And we've had multiple impact assessments and we report publicly on those. We actually did a webinar on that. The other I would call as asset attest is we talk to our customers. So we partner with a lean data company called 60 Decibels, where we will go using mobile surveys, talk to customers and ask them about their experience with our portfolio company financial services. And that data will come in to adjust and modify, but it also corroborates that we're having the impact that we want to have.
What are the impact-based hurdles that need to be met before you'll make an investment?
Interestingly, it's not a number, just the way financial, we don't say, oh, if you don't hit an IRR of this, we're not investing. It's directionally. So we measure this access quality markets. We set a benchmark of where they are. So we have a baseline measurement along these three dimensions, and then we'll set targets. For example, if you're a company that is serving, 50% of your customers are underserved, maybe we say we want to grow that to 75%. Or on the quality aspect, maybe we say if you have one financial product that is targeting improved financial inclusion, there might be others on the product roadmap that would help you improve a score. So it's personalized based on the business model and market, and we track it and measure against it. That was that annual review where we're giving a quantitative measure based on the targets we set. So there's no one hurdle. It's not like saying, we want to get to 87% financial inclusion.
Have you found that impact results align with or correlate with your portfolio's financial returns? For example, is there a linear correlation between the number of lives positively touched and the investment's financial return?
That was one of the most exciting conclusions. Remember, you mentioned a couple of years ago when we launched those impact scorecards, where we brought more quantitative rigor and substance to how those impact metrics. And it was graphed. If you look at 2 impact reports ago, Quona Impact Report show you graphically that we've now replicated every year. Interestingly, the best performing from a financial return point of view, the best performing companies were also the highest impact ones. There was a strong numerical correlation between impact and results that is driven mainly by scale and the results. So the biggest factor reinforcing that is that scale both feeds the access question as well as the financial return. There's economies of scales, there's efficiencies, there's defensibility when you're big. So a lot of that correlation is driven by scale, but there are other supporting factors that also drive the correlation. And it's not entirely surprising to us because we choose, remember you were asking me earlier about how do you choose companies? We're picking companies where inherently in the business model, in the unit economics, there's this reinforcement with wanting to hit marginal or underserved consumers and what drives economics in terms of financial return.
I think I understand how you're going about your business. So now can you give me an example or two of an investment that Quona has actually made that demonstrates the end-to-end investment process that we've been discussing today at a higher level? And maybe start from how you identified the target company and then what was involved in assessing their suitability and on to making the investment. And if you can tell me both the financial results and the impact results that you've achieved, just to make this real for listeners.
So probably so many examples. It's like asking a mom to pick her favorite child. But I'll choose the first one. It was our first investment, so it's easier, and it's we have the most track record with it. So our first example was a company called Creditas. It's a housing and auto equity finance company. So it's a company in Brazil where they discovered actually about 50% even of low and moderate income people own an asset. It might be a vehicle, it might be a small flat. But at the same time, these people who actually have a modest asset were to send their kids to college, were taking out triple-digit interest rate loans because that is what consumer credit was available, just unsecured loans, very, very high interest rates. And so something like home equity loans, which you think about, that doesn't seem so innovative. Home equity loans exist in the United States, and they exist in Brazil, but they only existed for the highest income segments because, again, in order to check and that the title is free and clear, in order to verify or source medium-term capital, in order to underwrite, it was just too costly to do that at a small basis, which is what these sort of moderate and low-income families needed. So what Creditas did is they found digital ways to do that very previously paper and people-intensive process. They also used some of the innovations in the capital markets that are available in Brazil. There's ways to do structured credit where the fintech, in this case Creditas, takes the junior tranche, and that there are other lenders who can do the senior secured, which allows you to really leverage your capital effectively. So a bunch of innovations that really made this company scale in a very exponential way. What's so exciting about Creditas, so not only is Creditas helping people send their kids to school, provide cost of financing that literally is a fraction of what it was available to before, and actually bring the cost of credit down in Brazil. It also simultaneously is one of the leaders in terms of building diverse workforces, measuring impact. So if you look at the majority of its customers, almost 70% of them didn't have access to formal credit before. So it really is opening up the market. And what's fascinating, if you look at Creditas, which is now valued over $3 billion and on the is already being shortlisted. It has Goldman Sachs as an underwriter to be listed in NASDAQ. As it has this incredible trajectory, which will return our fund many times over, we actually looked at the ROE and the ROA of Itaú and some of the large banks in Brazil. They've had their best years ever. So what's amazing is that it is opening up a whole new market that's not even making a dent yet. I mean, we want to make a dent ultimately, but what it shows is it's such a perfect example of there is an economy, and people talk about the informal economy. There's an economy and vibrant business that is invisible to most of the mainstream capital markets. And what our companies are doing are bringing them to life while offering very high quality financial services to those consumers and businesses on the margins.
What differentiates Quona from its impact peers? And I'm talking about beyond your focus on emerging market fintech. I'm speaking more from a competitive advantage perspective.
Yeah, the three core differentiators are what define Quona. Number one, there is no other venture firm that has as large a scope of fintech and emerging markets as we do. So quite simply, if you want a fintech specialist that can bring you examples from all over the world, from the Middle East, from Africa, from Asia, from Latin America, to bring to bear so you can give the entrepreneur actually a roadmap saying, you know what, not only do you have Klarna, which is a buy now, pay later in the US, you have a company called Adi in Colombia, or a company called Zest in India. Like you have these other examples of companies that we can use as learning and guides to another company starting the same model in their emerging market. So no other venture firm can do that, full stop. So that's number one. Number two is that we're local. I mentioned we're 29 people who speak 21 languages. So when I say we're local, it's not tourist capital like, oh, I worked at McKinsey in Hong Kong for a little year. Like we're born, raised, and built businesses in these markets. That's another very important point. When I mentioned my Comportamos journey, I'm not the only one. My co-founder, Jonathan, built 3 venture-backed tech companies in Latin America, 2 in Argentina, 1 in Brazil. Ganesh, my third co-founder, built tech companies in India. So this notion of actually having local experience, not just speaking the language, but really deeply understanding the market dynamics, the regulatory environment, the co-investors, the dominant mainstream players who can be partners and help you, or they can be roadblocks. All of that local insight we bring to bear again in ways that not many others can, certainly not in terms of the breadth. So that's the second big differentiator. And the third is the purpose. We are at Quona trying to build something bigger than ourselves. And that really motivates the best entrepreneurs. If you look at the most successful entrepreneurs, they're missionary, not mercenary. And they too have real aspirations. I think the best, I mean, not all, but I think it really resonates with them that we are here with a purpose beyond, yes, we want to make money. We want to make money for our LPs, but it goes way beyond that.
I want to talk about your secret sauce, or at least if my homework's right, what I think your secret sauce is, the global local approach that you have developed, niche, localized expertise. You have, I think, a footprint of people on the ground in something like 10 countries.
Mm-hmm.
And these countries are all emerging markets, which are not always straightforward places to operate in. And frankly, this isn't unusual for VCs. And your local resources, though, in these 10 countries are supported by a global network. The businesses you're investing in and these emerging markets you're operating in are nuanced and pretty niche. So how do you manage this localized aspect of your investment approach? How do you achieve that true localized knowledge that's in the end something actionable?
Great question. So I would say 3 things. Number one, it starts with the people. So, I'm here on stage, and if I could, and as rich a dialogue as we're having about my background, work experience, personal life history, and how it influences how Quona shape, that is multiplied by 29. They really are phenomenal. We're a really phenomenal team. We're very lean. We kind of practice what we preach. We like our fintechs to be lean, and we run the same way. And we hire exceptional people who are really united by a purpose. That starts with there. These people are also global local. They also are embedded in their team, and they're authentic. They're doing this because they want to be there and want to really support these entrepreneurs. We're very entrepreneur first. We're very customer service oriented. We get very high marks from our LPs as well as our CEOs. We actually do NPS scores annually. So we really pride ourselves on being connected and figuring out how we support them. So it's not just that we have great people at Quona. We have great people who are ready to go to work to figure out who are the key people that our entrepreneur needs to meet. What kind of resource do we need to bring to bear? So it really is, I would say, a critical part of this army we've built, army of entrepreneurs that I think are, probably the number one part of our secret sauce. And it's a team of them, which makes the dependency on any one less critical. I think the second, it's very important. I think the second is the platform we've built. So, and this is really, I would say, in the last 5 years, the second half of Quona's history, we've really tried to institutionalize that knowledge. So, resources that we have available, even on understanding emerging market realities. We actually are now helping regulators from one market learn from experiences in others in terms of actual legislation, whether it's instant settlement, EKYC. A lot of technical aspects that we are beginning to document and collect and collate and share. I think that is another very big part of our success, not only because it shares lessons learned, but it really, people look to us as one of the critical components of a well-functioning ecosystem. And the last thing I'll just say is authenticity. You asked me the question around impact. We are very straight shooters. The way we speak, the way we report, the way we support and do term sheets is clean vanilla. Work is hard, and we don't need to add spin and obfuscation. So we're straight talkers and straight doers. And I think that is also a big competitive advantage.
Are there similarities or differences between the different markets that you're investing in?
I'll say two things to answer your question. One of my favorite adages is what connects us is much more important than what differentiates us. And I mean that at a kind of human level in terms of what motivates people and what people respond to, but also in terms of our strategy. There's so many trends and pattern recognitions that really help us cross-fertilize. That said, there's a reason why we're based locally, because there is so much nuance from the regulatory point of view, for even culturally, how markets evolve. Like different players can really shape an ecosystem. For example, in Kenya, M-Pesa, like Safaricom really changes how mobile financial services plays out in Kenya. Or in Brazil, Nubank and its dominance now really has defined a new landscape. So there's not a Nubank in every country, just the way there's not an M-Pesa in every country. So really figuring out how you can win and succeed and build a winning strategy is, I think, nuanced and tropicalized.
Are there notable differences across the regions or countries you're operating in?
There are, and it's kind of tricky because, you have to be able to sell and present in a compelling way. And there's definitely, even culturally, just differences on how deferential you are in how you speak. We have to be a little careful because there's ways in which you can discount certain entrepreneurs or markets because they're just culturally very different. That said, ultimately you're raising from the same pool of growth capital and follow-on capital. So either we need to coach them and help them, be effective in different audiences, but you can definitely tell even the command of the English language is very different in different markets. In some markets, it's, almost it's like a second official language of the country. In others, it's clearly not, and you can see that sometimes in the pitches.
You're operating in countries that some people facetiously refer to as funny countries. How do you think about risk in these markets, and are there key risk metrics that you look at for managing this?
Venture is about risk, right? Venture is about risk management and finding out how to find the opportunity, because risk is what keeps people, if it were easy, everyone would grab the pearl, right? It's because it's hard to discover. So yes, these are risky markets. I laugh, Mexico has had more stable FX than the UK or the US. So, again, it really depends on what kind of risk, and each of these markets goes through cycles. So that's another really important thing to remember. And also very important to remember that even though we have active presence in about 10 countries, the majority of our capital is in 4. Brazil and India are the biggest recipients. They represent over half. And if you add Mexico, Indonesia, and South Africa, you're almost at 75% of our capital. We're not as far flung as our map would show, which I think, again, is back to that, positive in terms of, good diversification, but not spread so thin or you're taking kind of this really fringe risk. The biggest, in terms of measuring, we do this portfolio scoring. We have like red, amber, green dashboards, usually around cash flow And we always do a macroeconomic assessment as a precursor to our quarterly reports. Probably the one area that I think is where we have to really sharpen our pencils is regulatory. That's the area that can be influenced by different political administrations. They can change quickly, and once they're there, they can be a real impediment. So the regulatory risk is probably the one, which is true of fintech, I would think, globally, but it's also very true in emerging markets.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.